Hello everyone and welcome to another Stock Unlock video. In today's video, we are going to be going over balance sheets, and I want to show you guys the key things to look for on a balance sheet and really how to analyze one. Now, first off, what I should explain is what a balance sheet actually is. The balance sheet is one of the three key financial statements that companies report on a quarterly basis to the public and to their shareholders. The balance sheet gives investors a very strong insight into the company's financial health. It includes things like the company's total cash position, how many assets the company has, how many debts and liabilities the company has, and how much shareholder equity the company also has. Knowing how to read a balance sheet is absolutely critical to long-term investing and finding fundamentally sound businesses. If you know how to read a balance sheet, you can avoid some seriously bad investments and really see if a company is financially sound or if it is about to go bankrupt, literally. In this video, again, we are going to be taking a look at the key things to watch out for on a balance sheet, the key things that you should know, and also taking a look at some examples, some real world examples here. It's going to be an exciting video, and it's going to be an information-packed video as well. So I hope you guys enjoy, and let's just hop right into it. So we're going to be taking a look here at Google Stock on Stock Unlock, and how you get to a company's balance sheet is you hit on the Financials tab right here, and then you hit on the balance sheet. We are already at Google's balance sheet, so yeah, I don't need to click again or anything like that. Now, when you get to a company's balance sheet, what you're going to see is literally just a wall of numbers. And if you're someone who does not love numbers or taking a look at all of these numbers, then this is probably going to be incredibly intimidating to you. And I promise that it's not actually that intimidating, and there are just some key things that you want to look for here. But to make all of this less intimidating, what we can do is actually just collapse all of these rows, and then what we are left with is the company's assets, its liabilities, and its shareholder equity. Now, let's just dive into this. So what a company's assets are is like everything that the company owns that can be liquidated into cold hard cash. You as an individual have assets. If you own a house, that is an asset. Even your couch is an asset. You can sell your couch or you can liquidate your couch and produce cash. So anything basically that you own personally that you can sell and get money for is an asset. And this is the same thing with a company and its balance sheet. Liabilities on a company's balance sheet are like debts. I like to think of liabilities essentially just as debts. So you also have your own personal debt. Probably, well, most of us do. Like if you have a mortgage, that is technically a liability, that's technically a debt, and also credit card debt would be like a personal liability. This is the exact same thing for a business, and the liabilities that they report here on their balance sheet are just debts that the company owns. Now, the shareholder equity, the bottom line here, is simply just the assets minus the liabilities. The shareholder equity is essentially just how much net assets the company owns. So again, when you have the assets and then you subtract the liabilities, the shareholder equity is what is left over. And typically investors like to see a positive shareholder equity because if the shareholder equity is negative, then it means that the company has more liabilities than assets. And that's probably not a very good financial position to be in most cases. There's some cases where it's not such a big deal, but 99% of the time, if a company has negative shareholder equity, that is a red flag. Also, shareholder equity is known as book value. So if you hear someone talking about book value ever in the stock market, that is the exact same thing as shareholder equity. So now let's open up the assets. And when we open up the assets, we have two different main categories. These are the current assets and the non-current assets. In the world of investing, current just means within the next year or within the next 12 months. So when we see current assets, these are assets that the company has that can be liquidated into cash very easily, or assets that the company is planning on liquidating or selling to produce cash within the next year. It's essentially the amount of assets that the company has that are very liquid and can be easily transferred into cash. If we also click here and expand the current assets, we can see that the assets in here are like cash and cash equivalents, short-term investments, the total cash position, the receivables, inventory, and other current assets. In this video, I'm not going to go line by line and dive into what every single one of these lines means, because here on Stock Unlock, we have something called education mode that you can toggle on in the top right. And then if you ever have a question on what any of these different things are, toggle on education mode, and then you will see all of these question marks pop up all over the site. And then if you don't know what net receivables are, you can just click on the question mark and Stock Unlock will explain it to you. And in a lot of cases, we will actually have tips and like how to use it as well, if it is a very relevant piece of information or metric. So yeah, again, I'm not going to be going through the whole balance sheet line by line, but the main things that you do want to pay attention to in the current assets is the total cash position of the company, because this is literally how much cash the business has. And then also just the total current assets in general. This is pretty important to know, and we will be explaining why later on. But then outside of the current assets, we have the company's non-current assets. And what non-current assets are just assets that the company has that it is not expecting or planning on liquidating within the next year. So for example, right here, we can see that property, plant, and equipment is on the company's balance sheet as non-current assets, because in this case, Google is not really looking to liquidate its property, its plant, or its equipment. So Google's not really looking to sell its real estate. But yeah, so real estate is like a company's long-term assets or non-current assets. And then we also have long-term investments here, goodwill, intangible assets, and the works. The other very important thing in the non-current assets here is goodwill. And this is something that you are going to want to pay attention to, because goodwill goes on a company's balance sheet when it actually acquires another company. So we can see here, for example, that Google has $23 billion worth of goodwill on the balance sheet. And this goodwill has been accumulated over time from Google actually acquiring other businesses. Goodwill is essentially the amount that the acquiring company overpays for another business. So if there's a business on the stock market that's trading at like a $4 billion valuation, and then Google wants to come in and buy that business, typically it will have to pay a premium. So let's say that Google buys that business for like $6 billion. That means that Google overpaid by $2 billion for that company, which means that there will be $2 billion worth of goodwill on the balance sheet. Goodwill is also like one of these assets that a lot of investors, even myself, don't really love, because in that explanation, you know, goodwill is literally a company overpaying for another business. So is this really an asset? And a lot of investors' opinions, and my own as well, not really. And Warren Buffett, who is one of the best investors of all time, actually says that goodwill is what he calls a phony asset, because again, it's just not really like a real tangible asset. This is also the exact same thing here for intangible assets on the balance sheet. Intangible assets aren't tangible. These are things like a company's brand name or its relationships with its customers. These things aren't really like hard assets that you can really sell, but they do kind of still have value. Like think about Coca-Cola's brand name. Coca-Cola is recognized by billions of people around the world, and it does have a real value, but it's kind of hard to value an intangible asset. And typically investors such as Warren Buffett and myself, we like to group things like goodwill and intangible assets under this phony assets category, and just call these two things in general intangible assets. So it is important to watch out for the goodwill and the intangible assets, and I will be showing you how investors can account for that a little bit later on here. But that basically wraps up all of the assets. So the next thing that we have is liabilities. Now, we also have current liabilities and non-current liabilities. And based on the explanation for current assets, I'm sure that you can all guess what current liabilities are. Remember, what does the word current mean in the investing world? Well, it means these are the amount of liabilities or the amount of debt that the company has to pay off within the next 12 months or within the next year. So the current liabilities figure is quite literally how much money the company is going to have to pay off in debt over the next 12 months. And then the non-current liabilities is essentially the company's long-term debt. This is debt that the company has, but it is not due within the next year. And honestly, in the current liabilities, I don't really pay attention too much to what all the specific current liabilities are. I just like to pay attention to what the total number here is. So in Google's case, we can see that they have $62 billion of current liabilities. Now, in the non-current liabilities, the one thing that I do like to pay attention to is the company's long-term debt. Long-term debt is quite literally what it sounds like. It's just the company's debt that it has, and it's going to have to pay back over the long term. And this is really important to pay attention to, because if a company has a massive amount of long-term debt and it doesn't really have a lot of assets, then, well, you got to ask yourself as an investor, can that company pay back its debts? Because one day it's going to have to pay back its debts. And if it can't, then, well, that's not a very good situation to be in. And you as a shareholder could get into a pretty sticky situation. So yeah, that's basically the company's liabilities. And now let's take a look at the shareholder equity. And in the shareholder equity, Stock Unlock has tangible assets and intangible assets, which again are the goodwill and the intangible assets added together. And then we report that here as total intangible assets. And then we have the tangible book value. What the book value does, it essentially takes the shareholder equity or the book value, because those two things are the exact same thing. And then we remove the total intangible assets, which are the phony assets or the goodwill plus intangible assets. And that gives us the tangible book value. This is what a lot of investors, again, like Warren Buffett and myself, really like to pay attention to, because again, it removes those phony assets from the balance sheet, and it can show you a better indication to how many total tangible real assets that company has. And really what investors are looking for here is for the tangible book value to grow along with the shareholder equity. If we actually take a look here at Google, we can see that over the past 20 years, Google has been consistently growing its tangible book value. So even though Google is doing some acquisitions, again, we saw that Google has about $23 billion of goodwill on its balance sheet, we can still see that regardless of this goodwill, Google has been able to consistently grow its tangible book value. And for me as an investor and someone looking at a balance sheet, this is exactly what I like to see. I like to see consistent tangible book value growth. Now, also, what tangible book value growing actually signals is that the company is growing its tangible assets at a faster rate than it is growing its liabilities. If we take a look at Google here, I'm using Google because I think that Google has like one of the best balance sheets, and it's just a very strong example. But if we even take a look at Google, which I think is one of the best businesses in the world, we can see that Google's total liabilities have been increasing over time. Now, you may be thinking, is this a bad thing? Because liabilities literally are debts that the company has. And if Google is growing its liabilities, then again, shouldn't that be seen as a bad thing? Well, not really, because companies can actually take on debt, they can get some cash and then invest that cash back into the business and grow the business at a faster rate. And if the tangible book value for the business is growing, then again, it means that the company is actually using its debts and using its liabilities to grow its assets at an even faster rate. You just got to know that a company growing its liabilities over time is actually kind of natural in the business world. And as businesses grow, they typically grow their liabilities and their debts. So you really want to be paying attention again to the tangible book value, simply to see if the company is growing its assets faster than it is growing its debts. Now, also, you do want to take a look at the total assets and really just see, are the total assets increasing over time as well? Most businesses, they like to expand and they like to grow. That is like investors benefit from the growth of a business. And if a business can grow its assets over time, then you as an investor in that business, you're essentially growing your asset value as well. And here we can see on this chart, Google does an incredible job of growing its assets over time. It's honestly just a fantastic business in my opinion. Now, another thing that you want to pay attention to on the balance sheet is something that we call the current ratio. The current ratio takes the current assets of a business and it divides it by the current liabilities. The ratio essentially tells you how many liquid assets the company has relative to the debts that it has that are due within the next year. It essentially tells you how able the company is to actually pay off its debts that are due within the next year. So for example, let's pull out our calculator here, and we can see that Google has about $178 billion of current assets right here on the balance sheet. And we can see that it also has about $62 billion worth of current liabilities. So if we go to Google and we take $178 billion of current assets and we divide it by $62 billion of current liabilities, we get a current ratio of 2.87. Now, typically investors like to see the current ratio above 1, because if the current ratio is above 1, then it means that the company has more current assets than current liabilities, and it should be able to deal with its liabilities that are due within the next year. Now, the higher the current ratio, typically the more financially sound the business is. In Google's case here, the current ratio is almost 3, which is very, very strong. I mean, think about that. Google has almost 3 times as many current assets or assets that can be easily liquidated into cash than it has debts that are due within the next year. So Google has way more than enough assets that are liquid to deal with its debts that are due within the next year, which ultimately leads me to believe that Google is in a very financially sound position. And yeah, nothing really bad should be happening here. Let's say that, on the other hand, Google only had $30 billion of current assets, right? And it has those $62 billion worth of current liabilities. This would mean that Google's current ratio would then be about 0.48, which would essentially tell you that Google doesn't actually have enough current assets to pay off its current liabilities that are due within the next year, and ultimately would mean that its current ratio is below 1, which would also mean that Google, again, just doesn't have enough current liquid assets to pay back its liabilities, which does mean that the company would not be in as strong of a financial position. Now, luckily, Google is not in that position, and they have a very strong current ratio, and ultimately that tells me, again, that Google is in just a strong financial position and isn't going to go bankrupt anytime soon. So now let's actually move away from Google, and I want to show you guys an example of a company that has a ton of goodwill on its balance sheet, and this will really amplify the importance of taking a look at both the book value and the tangible book value. So right away, we can see the shareholder equity of TDOC, and we can see right here that from the third quarter of 2020 to the fourth quarter of 2020, there was this massive spike. I mean, take a look at this. In the third quarter, TDOC's book value or shareholder equity was about $2.2 billion. And then in the fourth quarter, it jumped up to about $16 billion. This is an increase of well over $10 billion in one quarter. If you're taking a look at just the book value, you may take a look at this and say, well, this is a fantastic thing. TDOC increased its book value or its net asset value by over $10 billion in just one quarter. But then if we go and take a further look at the company's assets and we take a look at the company's goodwill, we can see that from the third quarter to the fourth quarter, the company took on over $10 billion worth of goodwill. And remember, goodwill comes on the balance sheet when a company does an acquisition. So TDOC increasing its goodwill by over $10 billion in one quarter tells me that TDOC did a massive acquisition in this quarter, and it actually overpaid for a business by over $10 billion. And then you as the investor have to ask yourself, is this actually a good thing? Like, is this TDOC actually growing its asset value, or is this all just coming onto the balance sheet because the company did a ridiculously large acquisition in the quarter? And again, when you're taking a look just at the book value, all you're going to see is this massive spike. So let's expand on shareholder equity and let's take a look at TDOC's tangible book value, because this is a totally different story. Right here, we can see that TDOC's tangible book value in the third quarter of 2020 was about $153 million. And then in the fourth quarter of 2020, it dropped all the way down to negative $718 million. And TDOC today still has a negative tangible book value. So this essentially means that when we remove the goodwill and the intangible assets from TDOC's balance sheet, the company actually has more liabilities than tangible assets. So by taking a look at the tangible book value in conjunction with the book value, you can actually find some pretty interesting things here on the balance sheet. One more example of a company is Beyond Meat, BYND. And if you know me, you know that I actually do not like this company at all. And I'm going to show you one thing that I really do not like about this company. So we're going to be taking a look here at BYND's total cash position, because right here in the fourth quarter of 2020, they had cash of about $159 million. And then the next quarter, the company had cash of about $1.1 billion. So you may be looking at this and saying, well, you know, the company increased its cash position by $1 billion in just one quarter. The company is now cash rich, right? I mean, over $1 billion in cash. Cash is growing. That looks fantastic. Well, no. You kind of have to ask yourself, well, where did this cash come from? Like, how did the company just get $1 billion of cash and grow its cash position by like 10x in 3 months? And if we scroll down here on the balance sheet and we go down to liabilities and we go down to long-term debt, we can see that in the fourth quarter of 2020, they had about $100 million of long-term debt. And now the company has $1.1 billion of long-term debt. So you may see the cash position on a company like BYND absolutely spike. But then when you look further down the balance sheet, you can see that, well, hey, this cash came into the company's hands literally through long-term debt, which, you know, the company took on liabilities to get cash. And now if we take a look at the company's cash position, what is actually happening here? Well, the company took on that $1.1 billion of long-term debt, and over the past 4 quarters, it has now burned through almost half of it. It's now sitting on only $548 million of cash. So that, is something that you got to pay attention to on the balance sheet as well, is where is the company's cash coming from? Is it coming from debt? And then how is that company going to pay back that debt in the future? And if we actually scroll down here to BYND's tangible book value, we can see that BYND's tangible book value has actually been declining since about the first quarter of 2020. So this company's net asset value is declining, and the tangible book value is now sitting at about $41 million. So yeah, this company's cash position did increase, but when you take a look at the liabilities and the tangible book value, even though the cash is increasing, the company is taking on liabilities to do that, and the company's tangible book value is actually going down. So that is something to take a look at on the balance sheet as well. But let's head back over to Google really quick, because I want to show you guys quickly our Insights tab. Because here on Stock Unlock, we grade all of the key things that investors look for in a company's fundamentals and report back to you really quickly how the company's fundamentals are actually doing. And we also grade the company's financial health or its balance sheet. So right here, we're taking a look at our Stock Unlock Insights for Google's financial health. And we can see that we are grading the current ratio, the intangible assets as a percent of the total assets, if Google's shares are decreasing, the debt to EBITDA ratio, and then we also report that Google has more cash than total liabilities. So by taking a look at our Stock Unlock Insights and our financial health segment, you can easily see how financially sound that business is and also get some key information to that business's financial health and its balance sheet. So this is a really quick way to see the financial health of a business, and we do that for you here on our Stock Unlock Insights. But that's going to wrap up the video, everyone. That is the key things that I take a look at when I am taking a look at a balance sheet. Those are some good and some bad examples and just some explanations for you. So if you enjoyed this video or you found it educational or helpful in any way, then please remember to leave a like on it. It really helps out our channel. And please subscribe to our Stock Unlock channel. We are going to be making a lot more educational content going over the cash flow statement and the income statement. And I should also let you guys know that we have a full downloadable balance sheet document. It's about 13 pages long, and it goes into even more depth than I could in this video and kind of shows you guys some more things that you should be looking for on a balance sheet. So yeah, that link that document will be in the description. It's totally free. We just want to help you guys become a better investor. That is what Stock Unlock is all about. All we want to do, our mission is to make you a better and more profitable investor so that you can grow your wealth. And yeah, download that document in the description. Leave a like on the video if you enjoyed it. Subscribe to the channel if you want to stick around to see more content like this. And thank you guys so much for watching. We truly do appreciate it, and we really hope to see you all again in our next video.